Welcome back to Investing Talk Podcast.
Great to be here.
Today we are diving into, well, one of the more talked about names in specialized fintech, Fold Holdings.
That's right.
And the big question we're trying to tackle is pretty straightforward. Is Fold Holdings actually a good buy right now?
Mm-hmm. And we've pulled together quite a bit of info for you, recent reports covering, their Q2 growth, some technical signals.
But also balancing that against the risks.
Right.
Like dilution and fundamental health.
Exactly. Plus, there are some potentially big catalysts coming up just around the corner.
So for anyone maybe not super familiar, Fold Holdings operates in this, let's say, high-risk, high-opportunity space.
Yeah, focused entirely on Bitcoin-linked consumer financial products.
Think rewards platforms, but the main reward is Bitcoin. They even offer things like FDIC-insured checking accounts and a Visa debit card that gives crypto rewards.
And the sources taken together, they paint a picture, don't they? It's rapid growth, bold moves operationally.
But also, like you said, risk. The market seems really divided. Bulls love the vision, bears are pointing to the lack of profit and shorting it.
It's a classic growth versus value story, almost.
Definitely. So if this analysis helps you get a clearer picture or figure out your own view, please do subscribe, like the video, leave a comment.
Yeah, and let us know if there's another company you want us to break down like this. We do read those comments.
Okay, let's unpack this recent performance because, wow, the last 3 months have been a bit of a roller coaster for Fold Holdings.
That's putting it mildly.
Starting with Q2 2025, reported back in August. What jumped out from those numbers?
Well, the headline was growth, just pure growth. Revenue surged 59% year over year, hitting $8.2 million. That's impressive on its own.
But for a consumer fintech, it's really about users, isn't it?
Absolutely. And that's where it got really eye-popping. New accounts were up a staggering 233%.
233%.
Yeah. Shows they're really resonating and bringing people onto the platform, even in, a tricky economic climate.
And alongside that, they secured a pretty significant financial tool, that $250 million equity purchase facility.
Right.
For listeners maybe not glued to balance sheets, what does that actually mean in practice?
Think of it as a safety net, essentially. It gives them the option, not the obligation, to sell stock to a specific funder over time to raise cash if needed.
So it's basically a big vote of confidence.
It really is. It signals that someone believes they can execute on their expansion plans and warrants having that liquidity available, even while they're still burning cash for growth.
And they didn't waste time putting potential capital to work launching that Bitcoin gift card.
Mm-hmm. Aiming for nationwide retail. That's a big step beyond their core app users, trying to hit the mainstream.
Okay, so strong growth, funding secured, new product, but then things got weird in September and October.
Weird is a good word, or maybe just divided. In September, the stock rallied hard, up over 22%.
Despite the fact that everyone knows they're still losing money, right? The underlying losses were clear.
Exactly. Which tells you investors were, and maybe still are, really focused on that long-term story, the growth narrative.
They're willing to look past the current bottom line for the potential down the road.
But not everyone was buying it. At the same time, short interest was actually rising.
Ah, so the battle lines were being drawn.
Clearly. For every bull buying the dream, there was a bear betting they couldn't reach profitability before, well, maybe needing more cash or diluting shareholders further.
And that division really came to a head in October with the analyst ratings, which were all over the place.
Yeah, you had Weiss ratings hitting them with a sell. Wall Street Zen issued a downgrade.
But then Cantor Fitzgerald, a pretty big name, comes in and initiates coverage with an overweight rating and a $6.50 price target.
How do you even process that? A sell and an overweight almost side by side.
It really highlights the different perspectives. Maybe Rice is focused purely on current financials and valuation, while Cantor is betting on the future growth and the sector's potential.
Seems plausible. It's like they're looking at two different companies almost.
What's interesting, though, is despite that conflict, the overall consensus rating somehow still lands at moderate buy.
So on balance, the market, or at least the analysts covering it, still leans slightly positive on that growth story.
Okay, let's shift gears a bit and dig into those fundamentals.
Yeah.
Because this growth versus profitability tension is really the core issue.
It absolutely is. And the analyst projections for future growth are, frankly, phenomenal.
Phenomenal how? Like, what are the numbers?
Well, the consensus expects revenue to leap another 57.1% next year. So going from an estimated $37.4 million for this year, 2025, up to nearly $58.7 million projected for 2026. If they pull that off, that's incredibly fast growth in this sector.
Okay, that's the bull case on revenue. But the reality check is profitability or the lack thereof.
Right. The trailing 12 months net loss, the TTM loss, was over $34 million.
Ouch.
Yeah, which works out to an earnings per share, or EPS, of negative $1.16. They are definitely burning cash to achieve that growth.
So the whole investment thesis hinges on whether they can scale efficiently, right? Can they turn that growth into profit eventually?
That's the million-dollar or maybe billion-dollar question. The outlook is for improvement, significantly so.
How much improvement are we talking?
The estimated EPS is projected to go from about negative $1.29 this year to negative $1.31 next year.
Okay, still negative, but a big step in the right direction.
Exactly. And that hinges on achieving what's called operating leverage.
Meaning their costs won't rise as fast as their revenue.
Precisely. Once the platform's built, each new customer should, in theory, cost less to serve and contribute more to the bottom line, improving margins.
What about their financial health right now? Balance sheet? Liquidity? Does it look okay for a company burning cash?
It looks, I'd say, prudent for this kind of high-growth stage. Their debt-to-equity ratio is reasonable at 0.90.
Okay.
And the current ratio, which measures short-term assets versus liabilities, was 1.60 back in August. That suggests they can cover their near-term obligations.
So they have cash reserves.
They do maintain cash, yes. But, and this is crucial, they're not generating positive free cash flow yet.
Which means they rely on external funding, like that equity facility, to operate.
Correct. And that brings us squarely to the biggest risk factor for investors.
The one that makes a lot of people nervous? Share dilution.
Bingo. This is so important if you're looking at these kinds of growth stocks. Shares outstanding increased. Get this. 317% year over year.
Wow, 317%.
It reflects just how much capital they've had to raise to fuel that expansion we talked about.
So if you were an early investor, your piece of the pie got significantly smaller.
Dramatically smaller. That's the price of that aggressive growth, and it's a major headwind for existing shareholders.
Is there anything offsetting that dilution risk? Like, is management aligned with shareholders?
Well, one positive sign is high insider ownership. Management and founders still own nearly 23% of the company.
Okay, so they have significant skin in the game. They believe in the long-term value creation.
It suggests conviction, yes. They're betting that the eventual pie will be so much bigger that their diluted slice is still very valuable. Institutional ownership is also creeping up, though still low at around 4%.
And zooming out slightly, what about their competitive advantage? What makes Fold Holdings unique in a pretty crowded fintech world?
I think it's their very specific focus. They are squarely targeting that intersection of traditional finance and Bitcoin rewards.
So the FDIC insured checking, the Visa card, but all linked back to earning crypto.
Exactly. It's not something a legacy bank can easily replicate quickly. That integration checking, debit, rewards, crypto custody, it creates a kind of early stage moat. It's unique how they blend those worlds.
Okay, that makes sense. Let's pivot then to what's coming up. What should people be watching in the very near term? Q4 looks packed.
It really does. The next 3 months could be pivotal. First up, circle November 11th.
Okay, November 11th. What's happening then?
That's their Q3 2025 earnings release. This is critical. They absolutely need to show those growth metrics are continuing or even accelerating.
So validation time for the narrative.
Pretty much. Then just a week later, November 18th, there's ETF rebalancing.
That sounds technical. Why does it matter?
It can be a source of buying pressure. If Fold Holdings meets the criteria for inclusion in certain ETFs, those funds have to buy the stock, which can boost demand and liquidity. It's often overlooked.
Got it. What else is on the calendar?
The big one, I think, from a product perspective, is the Fold credit card. We should get a holiday launch report around December 15th.
And the wait list for that was already huge, right?
Over 75,000 users last we heard. A successful launch and positive initial data from that card could be a major catalyst for sentiment.
Okay, credit card launch mid-December. Anything else?
One more date for the calendar, January 5th, 2026. That's when they'll likely do their Bitcoin Treasury year-end disclosure.
Because they hold Bitcoin on their balance sheet.
Exactly, and a substantial amount. So that disclosure, combined with whatever the Bitcoin price is doing at the time, creates headline risk, positive or negative.
So lots of potential volatility drivers just in the next 90 days. Definitely. Now, if we look at the technical chart picture, you can see why the bull's been getting more optimistic recently.
Yeah, the stock definitely bounced hard off its 52-week low. It was down near $2.50 and recently got back above $4.
As of early October, it was around $4.12. The momentum seems to have shifted upwards.
And the moving averages are telling a story, too. It's been trading consistently above its 50-day moving average, which is around $3.77.
That's a shorter-term positive signal.
Right. But more importantly, it's getting very close to its 200-day moving average, which is up around $4.32.
Okay, for listeners maybe not deep into charting, why is crossing the 200-day average significant?
It's often seen as a major technical milestone. Crossing above it can signal a shift from a long-term downtrend to a potential new long-term uptrend.
So it acts like a trigger for momentum traders.
It often does, yeah. It can attract a new wave of buying, suggesting a more sustainable shift in how the market views the stock.
Based on all that, what kind of trading range are technical analysts suggesting for the next few months?
Well, factoring in the volatility and potential catalysts, the range being discussed is roughly $3.40 on the low end, up to maybe $7.20 on the high end.
Wow, that's a wide range. Heavily skewed to the upside if things go well, though.
If those catalysts hit, yes. But the potential downside is still there if they stumble.
And we can't really talk about a stock like this without mentioning the speculative buzz, right? The rumors.
Oh yeah, there's always chatter around these high-growth names.
What kind of things are being whispered about?
Well, there are unconfirmed reports, maybe wishful thinking, about a potential big co-branding deal, like with a major global retail chain.
That would be massive for visibility and adoption, especially for the gift card.
Absolutely. Then there's the perennial rumor, a potential takeover.
By who? A bigger fintech.
That's the idea. A legacy player wanting to buy instant exposure to the Bitcoin consumer market. It makes strategic sense, on paper at least.
And any regulatory buzz.
Some speculation about potential approvals for new cross-border Bitcoin transaction services. That could open up completely new international revenue streams pretty quickly.
Okay, so lots of potential catalysts, both confirmed and speculative.
Definitely adds to the intrigue and the volatility.
So let's try to bring this all together. We've got explosive growth, but significant losses and dilution. We've got technical momentum, but conflicting analyst views. We've got near-term catalysts, but also execution risk. How do you summarize the investment thesis here?
I think the term the analyst uses is apt. It's an asymmetric risk-reward opportunity.
Meaning the potential upside significantly outweighs the potential downside.
Potentially, yes. We know the risks. The cash burn, the 317% dilution. That's the downside case. Maybe the stock languishes or falls further if growth stalls.
But the upside?
The upside is driven by that massive growth potential. If they execute, hit those revenue targets, leverage the platform, then you look at the analyst consensus price target.
Which was where again?
Around $7.83. That's what, 130% above the early October price?
Okay, that's definitely asymmetric. If they hit anywhere near that, the dilution becomes less painful in retrospect.
Exactly. So the argument is that the potential reward justifies taking on the significant risk.
So who is this stock potentially attractive for then? Short-term traders, long-term believers.
I think you could argue both, honestly. Short-term traders might play the volatility around the Q4 earnings and the credit card launch.
Riding the catalyst waves?
Right. But long-term investors might be looking at the structural shift towards crypto-linked finance, betting on Fold Holdings as a leader, and maybe hoping for that eventual takeout premium.
So if you had to put a number on it, like a rating?
Based purely on the sources and the balance of potential versus risk, maybe an 8.5 out of 10 bullish, but with a huge asterisk.
That's the asterisk.
You absolutely need the stomach for extreme volatility, and you have to accept that dilution risk is very real. This is not a set-it-and-forget-it stock.
Understood. High risk, potentially high reward. Now, for a final thought. The sources kept mentioning Fold Holdings as a potential M&A target.
Yes, it came up frequently. Larger payment companies wanting their tech and user base.
So, thinking about that angle, beyond just hitting revenue numbers in the upcoming Q3 report, what specific metric should someone watch for? What might make a potential acquirer feel like they have to make a bid?
That's a great question. It probably comes down to the efficiency of their growth.
Meaning?
Look closely at their customer acquisition cost, or CAC. Is it trending down? Are they acquiring those hundreds of thousands of new users cheaply?
Because a buyer isn't just buying users, they're buying them at a certain cost.
Exactly. If Fold Holdings can show in November that their CAC is low and improving, proving their growth engine is efficient and scalable, that might be the number that makes a takeover financially irresistible for a legacy player weighing build versus buy.
So don't just look at the top-line growth, look at the cost of that growth.
That's what a smart acquirer would be laser focused on.
Excellent point to leave our listeners with. Something to definitely watch for in that November earnings release.
For sure.
Thanks for joining us for this look at Fold Holdings. We'll catch you next time on Investing Talk Podcast.